Welcome back, everyone. We have a very exciting day tomorrow. We have the inflation report coming out, and I wanted to do just a quick video on my game plan, what I plan on doing. I also want to go over this piece of data here. It's JP Morgan's game plan on CPI day. I've done one of these before. It's just a simple chart that shows what they think the probability is for different outcomes and then how they believe the S&P 500 will trade given these different possible outcomes. So we'll be looking over that, but I also want to go over a brief overview of why inflation is important and how this actually affects your portfolio. For example, we all have our portfolios. I have the passive income portfolio here. I have the story fund. They have lots of different investments, different companies that I'm holding. Now, if you're just an investor and you're focused on your companies and your investments, I think that's fine. You don't have to worry about inflation. But I also think it's good to understand why inflation affects our portfolios. Some companies are better suited to deal with high inflation environments than others. For example, one company in my portfolio, MasterCard, is very well suited to deal with high levels of inflation. Why does this one do so well with high levels of inflation? Well, think about this for a minute. Inflation means that prices of things go up, and sometimes they go up out of control. MasterCard's business model is taking a percentage of every transaction that people do with a MasterCard. Since it's percentage based, even if prices go up, MasterCard just earns more money. So they have a natural hedge against inflation. But a lot of companies don't have quite that good of a hedge. A lot of companies are reliant on raising prices and trying to work with logistics and trying to do other things to keep their margins. Overall, inflation is a dramatically bad thing for investments, a bad thing for all of these different companies. And the Fed has said very openly that they are going to stop inflation. They're going to take it back down to 2%. The other big reason that I want to highlight that I think a lot of people forget about inflation is not just that your individual companies have a tough time dealing with it through price hikes and their different business models, but also the concept of opportunity cost. For example, we can look at the 2-year Treasury here. This is the government Treasury, the US Treasury, which means that this money is the risk-free rate. So the US government insures US Treasuries. There's no risk to it, which means that right now you can buy a 2-year US Treasury risk-free for 4.509% yield. That's the return you get on this. Now, if I go like this and I flip over, let's go over to the 5-year time horizon here. See how it just exploded in yield over the past year. From July, look at that. The yield went from basically nothing. You weren't earning anything with treasuries. All of a sudden, we're earning 4.5%. This is opportunity cost. This 4.5% is what you could be earning risk-free if you weren't choosing to invest in stocks. Now, if inflation goes up, the Fed has to raise interest rates higher to combat inflation, to slow down the economy. So that's the very simplified logic. Inflation goes up, same with the 2-year Treasury, and the opportunity cost for investing in different companies goes up a lot. Instead of earning 7 or 8% on your investments with an opportunity cost of only 2%, now your 7 or 8% has an opportunity cost of a risk-free 4.5%. So this does have a big impact on your investments, whether or not you pay attention to it. Now, what we have in this report coming up tomorrow, it says inflation is falling, and where it lands depends on these 3 things. So this article breaks it down into 3 different categories. We have goods inflation, which they say surging prices for manufacturing goods, such as autos and furniture, drove much of the inflation burst in 2021. So goods inflation, which are like hard goods, cars, and furniture, that was what initially drove inflation, and that has actually come back down. These type of inflationary items are coming back down in price. That surge is over. So goods inflation is basically done. Then we have a whole nother category. We're looking at rent deflation here, for example. It says, wait for it. Soaring demand for houses and apartments from low interest rates and remote working caused shelter to contribute to more than half of December's 5.7% core CPI inflation. But as Mr. Powell put it, disinflation in housing is in the pipeline. He sees this coming further down the pipeline, but it's going to take time. Every one of these has a bit of a lagged effect. So this could take another few months until we actually start seeing rent deflate. And then finally, we have core services, which right now this has the most debate. A lot of people believe that core services is not coming down in price, that this is not having any type of disinflation. Once food, energy, goods, and shelter are excluded, what remains are core service prices excluding shelter, what some economists call super core inflation. It is still running around 4%, Mr. Powell said. Until it drops, we see ourselves having a lot of work left to do. This is the single biggest item that they have a tough time getting down. It really hasn't budged so far. So these are the three different categories. We've basically defeated goods inflation. We have rent inflation in the pipeline. That one we can kind of see the light at the end of the tunnel. And then we have the services inflation, which this is the very sticky one that we don't even see the light at the end of the tunnel. We don't see prices coming down at all. So in this new report tomorrow, it would be great to see the core services come down in price at all. If we see any disinflation in this, that'd be a very positive thing. Now let's go ahead and take a look at the probabilities here. Keep in mind that last month in December, the inflation reading, the CPI reading was 6.5%. So basically what this is saying is if we have another reading that is 6.5%, then the market's going to go down because that means that inflation didn't budge. That's not a good thing. Anything above 6.5% means that we're going backwards and the market will go down. The S&P 500 will go down 2.5% to 3%. I think if we get above 6.5%, I personally think the market could drop even more than that. I think it would go above 3% drop if that happened. But who knows? That would be very bad news in my opinion. I sure hope the reading is less than 6.5%. They give that probability 5%, by the way. So very unlikely, but there is a chance that could happen. The next one's 6.4 to 6.5%. They give this a 25% chance, and they think it would cause a slight drop. Again, I think market participants, I think they'd be in it for a rude awakening if inflation really stays above 6.4%. The most likely scenario is 6% to 6.3%. So almost every bank, almost every analysis firm, they have their predictions of inflation to be somewhere around 6.2%. They give this a 65% probability. So by far the most likely, and they believe that if this happens, tomorrow will be a very good day. The market will be up 1.5% to 2%. Now, I also think it's very likely for this one to happen. I think it's going to be within this range, 6 to 6.3%, but I don't see the market reacting 1.5% to 2% up. Maybe it will, but in my opinion, I think a lot of this good news is already priced in. Like the market just went up today based on nothing, just based on inflation hopefully being good. So I think there's a chance that it could be 6% to 6.3 and the market basically just trades flat. And then finally, we have the last one here, which is if it's below 6%, we'll have a good rally, 2.5% to 3% gain of the day, and they give that a 5% probability. So these are the different scenarios that they give. I think it's interesting that they actually put this in paper. Of course, it's a lot of guessing. Nobody knows for certain, but I agree generally speaking with the probabilities here. I think that it's probably going to be 6% to 6.3. If that happens, I think the market will be up a smidget. I'm not expecting a huge rally or anything. And in terms of how I'm playing this, my game plan, I'm staying with my investments. I'm not making any short-term trades based off of this type of thing. I know it can be fun to make predictions and to try to predict what direction the market's going in the short term, but I think it's a losing strategy to invest based off of those short-term predictions. The companies that I'm buying, Canadian Pacific, Amazon, S&P Global, MasterCard, these are companies where I have underwrote an entire analysis on them, a thesis on them over the next 10 years, not based off of what inflation is going to be over the next 6 months. So that's what JP Morgan thinks. I thought it was interesting. I'm excited for tomorrow. Either way, my portfolio is set up if inflation comes in extra hot or if it goes down more than expected. I'm hoping that it comes down more than expected. But that's all for now. I hope you enjoyed, and I'll see you in the next one.